Phone. Okay, I'll start the ball rolling. I have this one question. The first part needs to be answered by Mr. Song, and then the second part needs to be answered by all the three experts. Okay, in the minds of the property investors and property owners, I think one of the key things is the interest rate factor. And with the US tapering of QE, a lot of people are quite concerned about rising interest rate, and we believe the government is also very concerned. So my first part of the question to Mr. Song is, when do you think this interest rate hike will come to Singapore and Malaysia? And second part is, if it ever comes, how much do you think the interest rate will rise? And that's for the first part. The second part is to the respective panelists. If this interest rate hike were to come, what would be the impact on the Singapore residential market, the Singapore commercial industrial property market, as well as the Malaysian property market? And what do you think will be the tipping point whereby the interest rate hike is too much for the market to bear? So that is my simple one question, but actually not so simple. Okay, we'll let Mr. Song to start the ball rolling.
Yeah, with that question, we can carry on for the evening session as well. But I think downstairs, very nice smell. I just walked past the F&B fair just now. A lot of nice makan down there, so we can all adjourn downstairs later on. Okay, on the interest rate question, good question. I think that's on the mind of everyone. Our view, our house view is perhaps we are still 1 year away. But, you know, I can make it easier for you in terms of what are the flag pole or, you know, the signposts that you can look out for. Obviously, from the US economy standpoint, the central bank would only want to tighten if there are signs that the economy is on a sustainable recovery. Sustainable means that you're seeing job employment being created consistently across all the key sectors themselves. We saw some of that signs towards the end of last year until the horrible weather came in and created havoc in December and January itself. So in a mindset, we are all like, well, we're not quite sure whether the recovery is still intact or not. Hence, we have seen, you know, wobbles in the markets. We have seen wobble in the US exchange rate as well. So to help you, because I won't be here every day, you know, look out for a couple of things. Next Friday, we have the job report. Unlike Singapore, you know, Department of Stats, where you have to pay for a lot of things, everything there is free one, you can just download there. Very thick one as well. Concentrate on a couple of things when it comes down to the Friday job report. It's always the first Friday of the new month itself, unless it's otherwise stated. And yes, look at the headline numbers. Headline numbers on the employment rate is one thing. We always want to look at the participation rate because unemployment is a ratio. It's about who's looking for work, who is actively looking for work. If you mai zhou gang and decided to have a holiday, you're not counted as unemployed. Only if they think that you're actively looking, okay, you put it in. So we want to look at one thing, participation rate. Are people starting to be enticed because they have social welfare? Mai zhou gang got money one. So basically, it's until they run out of money, but not quite soon just yet. So you want to look at the labor participation rate. Is it going up? If it goes up, that means, okay, let's go back and look for work. That's one thing. Second, in terms of the breakdown, is about, again, whether all the sectors, goods producing side, manufacturing, construction, services, whether it's bank, whether it's F&B, whether it's hospitality, whether it is healthcare, are they all creating net job or not? If you see that consistently across for data, you know that the central bank is also looking at the same thing. They are a bit more confident. Then the other thing is on price pressure. We come down to the interest rate. Are all these recovery in the jobs creating pressure on the price? Because if more people got money in their pocket and they start to spend, it push prices up, be it home prices, be it services prices as well. At this moment, still don't have. As we've seen, the US recovery in the housing market is just basically in the early stages itself. So inflation at this point still relatively mild. So the two things you look for when you come down in terms of, in your mind, where interest rate tightening will begin is those two things. Job markets, are they recovering sustainable basis? broad-based basis? Secondly, is this recovery fueling inflation expectation? If not, okay. If we start to see people talking about, wow, prices moving up, job market's a little bit firmer, you know, interest rate tightening is on the way. But before that, we all know that the central bank already is starting to withdraw money. If they continue with this plan, every meeting take out 10 billion, it's not talking about no money, it's basically saying I'm contributing or I'm putting in less. If that continues, that shows confidence. Up to some point later this year, we think US recovery means that all the 8.8 million jobs that was lost in the last recession fully recovered. Now they're adding to the job, then that will give them the confidence as well. So the simple answer to all that I've given you is, in my mind, it's probably 1 year away from interest rate. How much would it turn? Perhaps in a first tentative move will be that modest 25 basis point, in the US. At the moment, it's almost basically zero to 25, for instance. If they do, it probably will in that manner as well, one step. And what would that mean for our side here? Singapore, we don't have interest rate policy. We have exchange rate policy. Why do we have that? Because everything we want, we have to buy one, whether it is wheat or milk or sugar, all comes from abroad. Bread comes from Johor, for instance. So our exchange rate is used to keep up imported inflation. Because of that, we don't have interest rate policy. So interest rate is always tied to the key major rates, especially the US. So if they move 25, we will also move 25 and be pulled along that as well. So that is a long answer to a short question.
For those of you who are avid followers of the property market, you probably would have come across what is called a property clock. So when the market goes up to the 12 o'clock point, that's where interest rates go up and the property market will actually come down. So in theory, this will be what happens. When interest rates go up, borrowing cost becomes very high, economy will slow down, the property market will also be affected. So whether the property market in Malaysia will be badly affected will depend on how fast and how high will interest rates go. So when will it come? I'm comforted by what Mr. Song said, not so soon, 1 year. So at least I can still work for 1 year before I can retire for good. Yeah. So currently, interest rates in Malaysia is still quite benign. BRR 6.6, and in Malaysia we have a situation where banks lend money below BRR, so the effective interest rate is probably about 4.2%, higher than Singapore, but still very, very what they call affordable. Compared to, I remember way back in the mid-80s when we had the recession, the finance companies were charging 15-16% interest rates for housing loans. So that is very, very tough for anybody to buy a property. But currently 4.2%, I think it is still good. So for the next 1 year at least, I think the property market will still be okay. Thank you.
Okay, that's my 2 cents worth. I think I wish Mr. Song was my economics teacher back in school. That would be I will sure score A. Okay, anyway, to make it simple, I think the thing to remember about, there are actually several things to look at. Number one, all the current loans in Singapore are approved based on 3.5% interest rate. So there is already a safety margin there, right? They're actually approving your loan based on a higher interest rate, and which the banks are actually lending you today at a much lower interest rate. So whatever happens is expected to be gradual. Actually, you can see it coming. All right, if things do happen, you can actually see it coming, and interest rates very seldom in Singapore will actually increase drastically overnight. So you can actually see it coming, and you will have time to respond, and you will have time to take action if needed. The other group of people that will probably be affected are those that perhaps are already highly geared. Those that have taken a lot of loans in the past where we didn't have these TDSR ratios. I think these people may feel a bit more pressured, right, in the event that property interest rates do go up. But then again, if your properties are tenanted and the rents can cover your installment payments, I think you will also have time to react and respond to the changes that's taking place. So I wouldn't be too alarmed if interest rates do increase. You basically have time to react.
Okay, probably I'll do this. Let me share my macro view first on how is the real estate environment. Then I'll go into micro view how commercial industrial will be affected. Now, if you do some research lately, you realize actually Janet Yellen, the one who took over Bernanke, she has made some statement recently. One of the reasons I totally agree with Mr. Song that job recovery in US is far from complete, and she said that, right? She said job recovery in the US is far from complete, and she also, on a few occasions, stressed that she will continue the current Fed policies, that means keeping interest rate as low as possible, right? So I don't see reasons why they will raise interest rate in the very near future. And in terms, that's for US, in terms of Europe, Draghi, the head of ECB, has also stressed that it's only for the good to keep interest rate low. And let me tell you the scenario in Europe, and then you realize how can they raise interest rate at this moment. Now, if you read about Spain, India, I'm also surprised when I read about it. I read that Spain, the current unemployment rate is 26%. And I try and find between the 2 and the 6, is there a decimal place? No, is there a decimal point? Is it 2.6 or 26%? I was so shocked to read that Spain is on a 26% unemployment rate. And that means out of four working class, and one is out of job. So at this point, there's no way that Europe can actually allow the interest rate to rise because they need economic growth, and US has also stressed the same thing. So I'm in line with Mr. Song that interest rate rising will be at least 1 year from now. That's my view on interest rate. Now, more on the micro view. If one day when interest rate rise, how will it affect the commercial industrial market? Now, this is how I look at it. Let me use some maths to explain this mathematics. Now, currently, if you buy and rent out a commercial properties, maybe your yield, let me say, is 4 to 5%. Let me use, let me use 4%. Let's say you collect 4%, you buy this office and you rent out this office, you collect 4% from the market as a rental yield. Okay? Now, you now pay the bank 1.5% mortgage rate. The commercial rate is about the same as residential, 1.5. So you collect 4% from the market, you pay the bank 1.5% each year. So you're left with 2.5%. And of course, this is not just the only holding cost for real estate investment. You have other holding costs, like for example, your property tax, your MCST, and then you pay your agent every 2 years to rent out properties. All these are holding costs. So if you invest long enough, you know that every year you better set aside 1% for all these fees. So with 1.5% going to the bank, 1% for all these fees. So your holding cost is about 2.5% now each year to hold on to a property. Now, when you collect 4% from a market and you pay 2.5% away, that's to say you still have a surplus of 1.5%. That's to say your yield is positive. Your yield is positive. In any case, if you're hit by rising interest rate, okay, 0.5%, 1%, you are still above water. Because of a 4% yield they are collecting, you're still above water, that means your yield is still positive, right? Actually, if you are in industrial, it's even higher. Industrial is 5 to 6%, okay? So this is how I look at it. Whereas my views on residential is a bit, they're more risk. Why I say so? Because the current rental yield for residential is about 2 to 3%. It's quite, market's not doing so well for residential. So it's 2 to 3%. At 2.5%, let's take an average. 2.5% you collect condo rental yield from the market. You have to pay 1.5% to the bank. And another percent goes to actually your other fees, MCST, your property tax. So to say, actually condo yield in today's market is just barely break even. You collect 2.5, you pay 2.5 away. Okay? Don't talk about a condo you bought 5 years ago. I know today you're sitting on 6% yield. Talk about today you buy a condo and rent a condo today. So it's 2.5%. So it's barely break even. So in commercial industrial, there will be cushioning for interest rate when it rises. There's still some cushion to cushion the impact. Whereas for residential, you probably find that it's actually tougher. That's just my view on what if it rises, how it will affect the market. Yes.
Okay, thank you. Okay, I have the two questions from the audience. I'll ask the first question about private property price. Is it a good time to buy private residential properties now, or adopt wait and see attitude? Is prices going to fall by 10 to 15% by the end of this year? Maybe Eugene or Mr. Song, you want to try that?
I wish I knew. Okay, anyway, okay, should I buy now or should I wait? I think let's look at two sides of the story: new launches as well as resale market. If we look at the resale market in the past year or so, we have this phenomena. The holding cost for the seller is negligible, very low. Sellers are not under pressure to cut price, but we have buyers who have a different mindset of how property prices should be. So when you go to do a resale deal, very often you have this big mismatch of expectation. Seller would be looking at a certain price, the buyer thinks he'll be taking a big axe to chop the seller. See? So when you have this kind of phenomena, you have less deals happening because there's no meeting of minds. So if you're looking for resale deals this year, I think you will still see the same problem of mismatch of expectation. But having said that, there will be sellers who are looking to move on. They are already well above water. It's whether make more or make less. So if they already have a target property in mind which they want to buy, they want to dispose of this property, then they would be more negotiable in terms of prices. So in a nutshell, you have to source out all these buyers, all these sellers today, and that takes a little bit more legwork. Having said that, let's look at the new project sales. If you look at the recent few launches, you will find that actually new projects are still selling very well. All right, you can have few hundred units just transact over a weekend just like this. Okay, how is it? Why is this happening? Okay, why is it happening? Primarily because, number one, the developer has realized that in order to move projects today, all right, the key is actually the price quantum. The price quantum. So, secondly is this, with the ABSD framework, actually it has also forced the developer to price it very, very competitively. Imagine a scenario without ABSD. This 10% that you have to pay for ABSD, do you think you will be paying to the developer? Quite probably, they will push their pricing. But with the ABSD, they have to factor in the fact that they need to move sales. So prices will be very, very competitive in that sense. So what moves today, actually, if you look at transaction, is between the price range of 600,000 to about 1.2, 1.3 mil. Majority of the transactions are in this price band. Okay, why? Because there will be people who, instead of buying a $2 million property, and because I buy a $2 million property, I have to go to take loan from the bank. I take loan from a bank, I'll be subject to TDSR, which I may not meet. All right, so instead of stretching for a $2 million property, I will just go and buy a lower quantum property. So when you go to launches today, you will find that the low quantum property, the 600,000 to $1 million range, or the 600,000 to 1.2 million, they will be snap up. Okay, why? Because you can even don't take loan. All right, as we have seen in some of the recent project launch, that there is this liquidity in the market. So is it a time to enter the market? I think you have to answer that question for yourself. All right, what are you actually looking for? All right, if you're actually buying for the important thing is to look longer term. Okay, as I shared with you just now, the current weakness is only temporary. All right, the future does look good. Does look good because we have a proper plan in place, and being, you know, the efficiency of the government, things when they put on paper, it will happen. All right, so I'm trying to be bullish over the longer term. So if you're thinking of picking up something today, is it the best time? You are not buying at the absolute lowest price. Okay, I'll be very frank with you, but you're not also buying at the very highest price. So if you see something you like, and I think it's worth considering also. Okay.
Okay, the second question from the floor is about stamp duty. It's a very naughty question. We understand that the government has projected lesser stamp duty in their budget, in their new budget. Does it then mean that the government is looking at removing ABSD and SSD soon? If so, when do you think the government will remove the ABSD and SSD? Would Mr. Song want to try that?
I wish I know too. I suppose bottom line here is, it's really from the government standpoint, it is all down to if the current prices in the property market are stable enough for them to do any tweaking without creating a further sort of a return of the speculative element. So I think that's the most important thing you have to bear in mind. Whole idea of all this really is to create a more stable market. As pointed out by Eugene itself, Singapore, very simple story. It's only that big and population grows. Train everywhere soon. So you know that prices can only but go up they want it on a straight line, simple. If it can be economic growth 5%, income growth 5%, property price 5%, sibei sui. But obviously impossible to achieve in that environment. You always overshoot, undershoot. And this is where they are trying to get things on a more stable plan as well. Now, in terms of things like stamp duty, obviously a function of volume, because they do see that measures in place, likely transactions smaller as well, therefore collection on the stamp duty side to be weaker as well. It's not them predicting that, I think come September this year I'm going to remove. Not that. It's purely just projection based on some assumption that growth will be slower, i.e. transaction volume may be smaller, and therefore P times Q into something smaller as well. So in terms of all this removing, yes, probably it will be all these things that will be removed first. But again, it must be against a backdrop where the adjustment in prices becomes, in a sense, a trend. Prices are very clearly downtrend, and in a relatively steady manner itself, that taking away all these or some of these will not create further, I suppose, activities that could rekindle the, I suppose, speculative fever. Would they remove the TSR out? Probably not just at this moment, because interest rate hasn't started climbing yet. So if after rates start climbing, they start to see the effect, then perhaps they can tweak subsequently as well. So that will be, I think, still some way away. But in terms of all these other minor things like stamp duty and ADRs, yes. But again, it has to be market dependent.
Okay, thank you, Mr. Song. There's a third question, and this is directed at Mr. Tan Chi Ming. What is your opinion of condo around KLCC? Are there too many units present coming up? Is there sufficient aspects to rent this condo, especially the one-bedroom condo?
Now, KLCC is obviously a very prime area, and KLCC condos would have commanded very high selling prices. So, for people for investors who have paid that sort of prices, their expectations of yield is obviously high, but it is a big risk for them. But currently, sad to say, we don't have enough expatriates who are willing to pay that sort of rental. So that you see those big units that have been completed, they have been left vacant for quite a while. Some of the earlier projects have been a number of years already. But the smaller units, fairly easy to rent out, fairly easy to resell. Yeah. So the moral of the story is don't be too greedy, go for the big ones, then you end up with more difficulty. But if you look at it long term, KLCC land is limited. So it is a matter of time before demand will catch up with supply. And if that's the case, long term is good, but short term, if you drive around KLCC, you will see a lot of condos without lights. So it's not the best of time to just simply walk in and go and buy anything, but be more careful, look at the property, look at the prices that have been offered to you, check with the valuers. If the price that is offered to you is decent, I think long term cannot go wrong in a place like KLCC. Thank you.
Okay, there's a fourth question directed at David. Each one have a question. And also in the same order also. Okay, Mr. Po, I understand in the next 2 years, more than 5 million square meters of industrial space is coming on stream. And this is quoted from Business Times, 25th of January 2014. Thank you very much for quoting from SPH. So will prices soften rather than maintain or even increase for industrial space?
Okay, you only read about the supply, 5 million square feet, but if you do research, the demand that you projected is also about that, plus minus. But of course, when you say these are all figures, I do agree. Whether would there be an oversupply in the industrial space, it all depends on do we continue to have good GDP growth, good economic growth. If we continue to do well in the next few years, then more companies will need more spaces. Then I don't think industrial space will be actually in an oversupply situation. This will only happen if economies shrink and companies are downsized. Yeah. So I think whether there will be an oversupply of industrial space in the next few years, it all depends on how fast our economy grow in the next few years. Yeah.
Okay. There are these two questions to Mr. Tan Chi Ming. I'll combine them. The first question is, how do you view the future of Cyberjaya? And the second question is it better to invest in commercial properties than residential properties in Malaysia now?
Okay. For those of you who are not familiar with Cyberjaya, it was started during Dr. Mahathir's time. Yeah. It is supposed to be an area where you have got all those very high quality infrastructure, where you have all those high-tech businesses, those enterprises will set up business there, and they will then enjoy certain tax benefits. It attracted, obviously, a lot of those multinationals who wanted to take advantage of those tax benefits. They set up base there, but only a small unit, just to be able to qualify for the tax benefit. They also set up offices in KL, where a lot of their staff are located. Yeah, so in the very beginning, Cyberjaya was known as a place where people set up businesses, not as a place to stay. In fact, in the early days, I was talking to these people who were working for this multinational. They work there, but they commute daily. They stay in KL, they stay in Puchong. I asked them, would you want to stay in Cyberjaya? They said no. Cyberjaya is a place, is a city without soul. Because the thing is, there's no big shopping center. You want to go shopping center, you got to go Alamanda in Putrajaya, you got to go to Puchong, Subang. Not many eating places, you know, and the international school is not there. There's a ELS and all, but not a lot. But today, it is a bit different because a lot of the major developers have looked at Cyberjaya as an opportunity after the opening of the Max Highway. Okay, The Max Highway connects the city to Cyberjaya, and toe to toe is only 20 minutes. So for people who are looking at buying a home, look, Subang Jaya with the traffic jam and all that, you come down to KL to work, it takes you easily 40 minutes to an hour. But you stay in Cyberjaya, I mean, what they call, work in Cyberjaya, it's less than 30 minutes. So people begin to look at Cyberjaya, maybe, yeah, it's a possibility. And the developers who have built townships there are people like UM Land, people like SP Setia, Masing. So a lot of projects have been launched. So a lot of landed properties have been built. And in the commercial part of it, a lot of developers have bought small plots of land and they built Sohos, and so on. The current situation is that I see that there is an oversupply of Soho units there. So over the next probably 2 years, you will need to have a clearing of the excess stock. So I would say that for those people who have bought, they will have a hard time trying to rent out their units. Those landed properties present an opportunity for people to actually stay there and commute to KL to work, because now with the highway is shorter. But not a lot of people have relocated there yet. But I will see that there will come a time when people will actually want to stay there. I mean, look at PJ, when it was first developed many years ago, people were looking at it as very far away. But today, it is a prime residential area. Likewise, long term, I see Cyberjaya to be good, because a lot of the developers who are building there have master planned the townships, a lot of new concepts. They provide a better living environment. So it will actually offer an alternative in the long term. But currently, there is a bit of an oversupply as far as the Sohos are concerned, the apartments. Landed properties, some of the developers may have overpriced the units. So that's why they are stuck with stocks of unsold units. But with the right pricing, I do think that Cyberjaya is okay to invest.
Okay, in the interest of time, I'll just fire off one last question, which I think, you mean that gentleman has a question, then you will probably take the last question. Yeah, come.
Hello. Thank you. All right, I'd like to know your view about Iskandar Malaysia. In the next 5 years, we're going to have like the ferry going from Harbourfront to Puteri Harbour. And we're going to have the RTS from Woodlands to, right across the CIQ there. And we're talking about an oversupply right now in Iskandar Malaysia. Danga Bay is big, something like 40,000 units coming up. Do you see like mass migration of people from Singapore to Iskandar Malaysia, especially for the PRs and foreign workers who cannot buy HDB, and will they move up there to rent? That will cause an oversupply in Singapore.
Sorry. Before Mr. Tang answer that question, which rightfully he should, just to let you know that tomorrow we have one dedicated topic by Ms. Christine Lee, who will talk about Singapore Iskandar integration. So for those of you who only sign up for 1 day, I strongly encourage you to sign up for day 2 to listen to what Christine have to say for that 30 minutes and fire her with more questions. But for now, I think Mr. Tang can give you appetizer, flavor of his response. Thank you, Mr. Tang.
When STProperty first approached me to speak, I was actually asked to speak on the subject of Iskandar. I told them I don't cover Iskandar, I'm no expert. I don't want to speak on that topic. And I also think that I'll be caught in a dilemma how to answer these difficult questions, whether to invest or not to invest. Because right now, as at the moment, with so much supply, you have seen a few of these China-based developers who are coming, they have built not like our traditional way of Malaysians developers building 200 units, 300 units, 500 units. They came one shot 9,000 units. They launched in one go. Yeah, China, they can do that. Here, well, they can still do it because you buy one apartment in China, you get one free here. Why not? Yeah. But at the end of the day, the fear is whether it could turn up to be like Dubai. A lot of buildings, a lot of sales, but at the end of the day, who is going to occupy these places? I went to this city in Inner Mongolia called Ados. Very rich because of the resource, coal mines, and a lot of these coal miners became very rich. So rich, nothing else to invest. So what do? They buy properties, buy apartments, and so a lot of developers went there, built. And everywhere I go, I see a lot of empty blocks of apartments, empty offices, and that has been what has happened. Whether that will happen to Iskandar, I'm not sure, but I think the government is very conscious of that sort of thing. And I think they will be taking steps to make sure that it will not occur. And the other good thing is that Johor is just next door to Singapore. And because of the difference, the disparity in living costs, we are hopeful that Singaporeans can one day stay in Iskandar, commute to work, because traveling is easier made by the high-speed rail and so on. So that could help to fill up the empty spaces. So if you ask me, I don't have a 100% sure answer. So perhaps, as what our friend has said, sign up for tomorrow.
Does David, Mr. Song or Eugene want to comment on the Iskandar Malaysia question? The 6.9 million population, will some stay in Iskandar? You know, do you guys have any comment or views on this? Please.
I'm not an expert in Iskandar, but I did some research and I read about Iskandar because in my investment program, I do teach my graduates about Iskandar. I'm not an expert, but I do advise them on what I've actually researched on and what are my views on Iskandar. So I'll just share my views, even though I may be wrong, but just adjust my views. Now, if you read about Iskandar, there are many figures that will shock you. Let me just give you an example. I read about it not too long. It was in the Business Time. This figure is from the equivalent of our URA in Johor. They have actually 300,000 of apartments coming up in Iskandar, whether they are under construction or in the planning stage. 300,000. But some of you may not understand what does 300,000 means. Okay, let me tell you what does 300,000 means. From the first day we built a condo in Singapore, maybe 50 years ago, or maybe 40, 50 years ago, up to now, from 40, 50 years ago up to now, Singapore, if you check your website, all these figures are official, you can check it. Singapore has only about 300,000 or less apartments, condos. And Singapore took 50 years to build. But it took 3 years to build 300,000, either ongoing in a pipeline. So I think these figures are good figures that you can put it in the research. That what would it mean where Singapore took 50 years to digest this 300,000, but they actually are trying to digest it in 3 years. So these are figures maybe it will help you in digesting what you do. Yes, thanks.
Any comments? Mr. Song?
Well, I suppose the only thing I would say really is if you're looking to buy for investment, it's been pointed out by David himself, be very careful. There's basically no resale or rental over there. So, but if you're thinking of, having a place over there where weekend you go makan and then relax at home, that's a different issue as well. So obviously, then it comes down to where you want to choose. As you say, there are tons of opportunity. Obviously, look at those that are by established developer and where there are really a community. As we've seen, there are many projects where if it's just Singaporean who buy for the weekend, there's really no amenity around there. Which business can survive just Singaporean coming to buy kopi o in a weekend? Only they'll die. So I think these are things that you have to bear in mind when you do consider investment or to stay over. There are people who stay. I have colleagues, who stay over there. They don't have any children, so they are quite happy to stay over there. They come in to work early, they relax. When they want to go back, they go back itself as well. There are some of those like that, and they're quite comfortable. So all these really is your own need. What do you want to do? If it's investment, think more carefully. If it is about long term, you want garden and green, and maybe the occasional haze, that's fine.
Okay, I mean, I'm a realistic person. Iskandar is 3 times the size of Singapore, and it took us 50 years to reach where we are today. So if you are looking at Iskandar, I would think it's a longer term perspective. There are many attractive propositions there, and in fact, it's quite nice, all right, some of the things that are coming up. It's something that you really have to think long term. I won't think you can buy something today and reap the benefits in the short term. My colleague has a very interesting way of putting it. He said, if I buy something today, it's probably for my son to reap the benefit, right? So I think that in effect, I think his view is maybe quite right. So, but having said that, I think it's good to look around, make an informed decision. Basically, it sounds pretty attractive. I mean, you live away from the hustle and bustle. Every day with all these conveniences that are coming out, you can just commute to Singapore. But I think the important thing is to ask yourself this question is that you're going to do it every day, Okay, while you do it once, twice, maybe over the weekend, you just get to your, like Mr. Song says, if your weekend home, you just get there, it may be okay. But if you're going to live there and commute to work, like I have colleagues, they live in Malaysia and they commute to work every day, but because they do it every day. So, but if you ask them, it's actually very tiring, right? Yeah, to come to work. So yeah, so you have to really figure it out for yourself. Thank you.
Okay, can you join me to thank the speaker with applause? Please stay around. I'm sure you guys have benefited a lot from our speakers. We are going to hand over the speakers a token of appreciation. I hope you can stay around to show your support for the speakers for enriching us today. Thank you. Stan, is that a gentleman who wants to ask a question? Yes.
My name? Can you hear? It's okay?
Yes.
My name is Mohit. My question is to Ms. Christine Lee. She mentioned that one of the eminent gentlemen told that the Malaysian ringgit is going to depreciate in next 5 years by 15%. So that means that if I buy a property, say for 1 million in Iskandar today, and that property remains the same price for 5 years, and then I sell it after 5 years and bring that money back to Singapore, then I buy for 1 million. After 5 years, I will bring back 850,000 only. That's minus 150,000. Is it true?
Okay, theoretically, this is true because, okay, disclaimer, the prediction is by the econs professor, it's not me. But I believe there's some truth in it because if you look at the slides I showed, the investment to GDP ratio, or the debt to GDP ratio, they have busted the previous ceiling. So the government is going to print more money if they want to continue to support their debt, support their infrastructure development. So there is a possibility that ringgit is going to depreciate even more. But the silver bullet is read, do you remember the cooling measures that foreigners can only buy above 1 million ringgit? I think in 5 years' time, probably this restriction is probably not a very stringent criteria anymore.
Sorry, does Donna or Mr. Han wants to answer that question? I think that question is also talking about the depreciating Malaysian ringgit, and that could mean a reduction of the capital value of a Singapore investor who is investing in Malaysian property today, if the Malaysian ringgit continues to depreciate. I also registered that Donna has shown in his slide, Malaysia ranked one of the top 3 potential investment, foreign property investment destination. But yet there's also this concern of ringgit depreciation. So people say that it's cheap to buy now, but if it continues to depreciate, it will also depreciate capital value appreciation. So does the two Mr. Han next to me have any comments on this?
Thank you, Mr. Han. Investing abroad, one of the key variables is really your currency risk. So you got to hedge that currency risk on your loan quantum. The good news is that if currency of the other country were to drop, then if let's say you have taken a Sing dollar loan and you're paying, it can be Malaysian property or it can be UK, it shows that while Sing dollar currency has been appreciating, you are also servicing a loan which has got less to pay. You get it? It takes both ways if you are construing it on the part of paying. But of course, in terms of returns, you're going to get less as well. So it's all part and parcel of looking at where the currency is going. And the strength of the currency pretty much is dominated by the economy of the country. So again, you want to invest in a country where the economy is likely to see an improvement in economic growth. Then you'll see more foreign investors coming in. And then there is a potential for its currency to go up as well. So there's always risk. In fact, Sing currency has been one of the strongest in the last 2-3 years. So like it or not, other than maybe renminbi, you put your money anywhere else, there was a possibility that in the last 1-2 years, you have seen that particular country's currency coming down. But there should be other factors that should coexist in your decision-making process. One of them is yield. You must get higher than Singapore yields in order to circumvent the drop in currency. So also capital appreciation does help in any making decision because that can reduce the impact of your currency devaluation. Yeah? Thanks.
Thank you.
If I may just add a layman perspective, because I'm not an economist or an expert on currency matters, but I would advise that property investments be taken for a long term, especially if you're not so familiar with territories. 5 years seems to be very recent, a short period of time, short span. Probably you can look at 10 years or so, then there will be greater developments. The region and the country may do better with closer integration over time that can be expected too. So I think long-term foresight would be in many people's interest. Thank you.
I'm not a forex expert, but I can share with you what's happening in my project, Danga Bay. I think Danga Bay, as you know, we were the first one, we were the pioneers. We bought the land at, let's say, $100, all right, per $100 per square feet. Right now, the Chinese are buying 4 or 5 times higher than that. So the land prices is not coming down, all right? So land prices is not coming down, and also construction cost is not coming down. It's getting higher. In fact, we are getting problem getting contractors now because they are quoting 20%, 10 to 20% more than what they were quoting when we built Tropez. So in terms of, these are the basic costs we have to factor in. So everything is rising. So you must compare it with your forex gains.
I'll take the last question from this gentleman. Please bear with me for 5 minutes because I think this question is a very pertinent question in the minds of many Singaporeans because 80% of Singaporeans stay in HDB. Okay, I think this question is probably directed at Nicholas. It says, in the past year, prices of mass market private properties generally hold up better than HDB price. Is it good time for now HDB owners to sell their HDB to upgrade to a mass market condo before this gap widen further? Of course, that is if you predict that the gap between a mass market condo and a HDB will widen further in the line of the government continuing ramping of supply of HDB. And based on what you mentioned just now, government seems to have better control over HDB compared to private.
Hello. Okay. Actually, since after the last financial crisis, the subprime crisis, the Lehman Brothers crisis, if we were to go further back, that crisis actually didn't impact HDB resale price index much, you know. It dropped by 1 quarter, 2 or so, and then after that it rebounded. It is the private housing market prices that drop a lot and go up. So if we were to see that whole price trend, the whole bull run of HDB prices, it never took a break during the financial crisis in about 4 or 5 years ago. So if you were to start from a much earlier starting point, let's say during 2003, during the SARS crisis, that was when HDB prices do drop. And you take it that HDB prices actually have been going on all the way up for almost 10 years to 11 years. So during that time, it actually grew faster than private home prices, which is one reason why during the last election in 2011, people are complaining that why is HDB prices so expensive, and they have a reason. Yes, it has been growing faster than private property prices. But now it seems to have, roughly about 6 months or so ago, it has already hit a peak. We see that COV is falling and so on. So the question is, should I switch? Should I switch from HDB to private? I would say if you can, yes, it's time to look for that ideal home to switch over. Because HDB prices, I think, is likely to face a bit more downwards pressure, but I don't think it will crash. Because I don't think the government wants to make HDB affordable or available to many first-time home buyers, but they don't want 80% of the voters to have their biggest assets continue to shrink because 80% of us live in HDB flats. So they want the prices to remain stable, okay? Maybe within a range, plus minus a certain range. So if you want to upgrade, yes, this year and maybe even next year might be a good time to do so, but I think this year you can start house hunting. HDB resale prices likely to come under more downwards pressure in 2014. So if you are willing to take the going rate now, and I think some of the HDB buyers are already basically making offers at valuation. They are not, unless your unit is very special, they are not offering a lot of extra COV. You are prepared for that, then go ahead.
Does Christine or Donna wants to add on? Yep.
Maybe I just add on to why HDB prices run up so fast during the period in 2006 to 2010. This is because during that time, Singapore's economy is succeeding in a restructuring process, and we let in a lot of foreigners. At that time, the population grew at a very fast pace from 4.4 million to quickly to 5 million within a short span of 3 years. So you can see that a lot of the HDB owners, they actually became landlords, and a lot of the rooms were sublet to many foreigners, and that led to a result that a lot of people are keeping the HDB flats. They are not selling the HDB flats. But I think going forward, you can see that government is tightening the foreign worker inflows. Even the rentals for HDB flat has already slowed significantly. And going forward, you see government has ramped up this BTO supply. Every year about 25,000 units. So you can just imagine this imbalance of population and housing needs by the lower paid workers are no longer acute as the period during before the election. So going forward, we are not likely to see a spike in the HDB prices anymore. And if you think that the prices have already peaked and you can afford to buy a mass market condo, this is probably the best time to cash out your HDB flats because the good times are not coming back.
Okay. Okay. So can I have a last question from this gentleman?
Sorry, my question is actually quite related to the first one. If today I were to invest in a Malaysian property, besides the forex risk, right? If you were to take up a loan, okay, now I have two choices. I can either take up a loan in through a Malaysian bank in ringgit or a Singapore bank in Sing dollar. So currently the interest rate is about between Singapore and Malaysia is about 1 to 2%. Okay, how would this pan out if I were to look at it in a mid-term basis, like 5 years? Which is a better bet? Which bank? In which country? Maybe I have some views, please. Thanks.
So the question is, when you buy a Malaysian property, should you take a Sing dollar loan or a Malaysian ringgit loan? Which is a better bet? Donald?
Maybe I'll take a step on the question. If you borrow from Sing bank, you are affected by TDSR, right? Because the local banks would tend to share information, and then credit bureau, and under that, you will come under your 60% TDSR. But if you borrow from a Malaysian bank are out of the credit bureau Singapore system. So there's a possibility, there's a good chance that you might be able to get higher financing, assuming if you're a marginal case in a Singapore banking credit bureau landscape. So my suggestion is do your check on both. Both have got a pros and cons, but in some cases where buyers are on marginal cases and you want to be able to get better financing terms, you might want to look into your foreign banks to do your foreign property purchase.
Anyone wants to add anything?
Maybe I just add on a bit because a lot of the buyers, they are thinking of taking a Malaysian, they are thinking of taking the advantage of the current low interest rate. That's why they want to take the Sing dollar loan. But the problem is a lot of the Malaysian developers, they actually have a tie-up with the local banks, the local Malaysian banks. So only the Malaysian banks can offer you the good terms that Singapore banks cannot offer. And some of the Singapore banks, they are still assessing Iskandar market. They are not as comfortable as the local Malaysian banks. So some of the places, some of the Singapore banks don't offer Sing dollar loans to local buyers. And of course, with the prospect that Malaysia ringgit might depreciate, so it makes more sense to take up a Malaysian loan because over the period of over the course of the next 10, 20 years, you're going to pay in Malaysian ringgit rather than Sing dollar.
So anyone, any more? If not, then I shall. Okay, I know there are still many burning questions from all of you. I suggest if you have, then you can visit STProperty.sg. We have a Just Ask session. You can log your question there. My colleagues will try to transfer your question to the expert here and put an answer for you.